My name's Brett Ansley. I'm an Agile coach. I'm also Chief Product Officer of a startup working in sustainability. So pretty interested in both those topics, kind of Agile and sustainability. I worked for Thoughtworks for 6 years, and since then I've done some digital transformations on my own. And in all of those transformations that I've worked on, both at Thoughtworks and on my own, I started to recognize a pattern where we do a lot of work optimizing technology, and often the interfaces to other departments don't work quite so well. And the one in particular that I want to call out today is how we interface with the accounting and finance department. I was working on a project for a large e-commerce retailer. We got partway through the digital transformation, and I got an email from the head of finance saying, "You've got to stop this whole thing because we have no idea what you're doing and how we're going to account for the software." So part of this is born out of that experience of how we would then work with finance to understand what their needs were and how they needed to report on the finance implications of building software. For a start, I just wanted to find out kind of who's in the room. So how many people in the room are kind of in product management, product ownership, and developers, a few developers, project managers, okay, a few. Anyone else? A few other people, anonymous titles, okay. Scrum Masters maybe, yeah, probably a few, okay. So the problem space that we're looking at is technology creates, in technology or in product, depending on how your company is organized, we create this software and we're paid for doing that, right? Paid some money for doing that, often over the extent of the time of a project or a feature build that can extend to quite a lot of money. Finance wants to recognize that software as something. Normally it wants to recognize it as much of it as an asset as possible. Sometimes some of it has to be expensed, but generally they want to recognize it as an asset. The reason they want to recognize it as an asset so it can go onto the balance sheet of the company and increase the overall value of the company. So the company is paying you, they want to recognize some asset off the back of that. And they need a budget for it. But it needs to be recorded accurately, and there's some rules in accounting around how you record stuff and how you change values of assets. So we don't want to break any of generally we don't want to break any of those rules, maybe bend them a little bit, but we don't want to break them too much. What finance wants, they want to be able to budget. So up front, they want to know, I have this pot of money and I need to allocate it out and divvy it out to various different people and things and initiatives that this business is going to do through the year. I want to know how much you need so that I know whether I've got enough in the pot to finance all the other stuff that we're doing, like payroll, like inventory, like anything else that we need to buy. So they need to budget. They need an idea of how much this thing is going to cost so that they know how much of that money to divvy up. They want to recognize that asset as it's built. So as we're going through the build process, they want to recognize how much of that has been created in a way that can be recognized on the balance sheet as an asset. So they want to be able to recognize that. Then they want to be able to reconcile between how much of it has been monetized as an asset and how much is in the budget. Okay? We've created this pot. We understand that that pot might need to flex a little bit, like everything that businesses do. Pots of money flex. And actually the finance department were okay with us flexing the budget a little bit. But what they really wanted to know is, I still need to recognize how much of this I can stick on the balance sheet and how much I can't yet stick on the balance sheet and how much more I need in that pot before I can stick this whole thing on my balance sheet, right? So how much more do you need before I can go ahead? I need to know that because I've also got other budgets that are flexing, and I also want to keep an eye on how well I'm doing in terms of having this pot of money that finances our ongoing operations. And finally, they want to amortize it. And amortization actually talks into budget as well, because part of amortization is the taking of an asset and depreciating it over time. And part of that amortization is attribution. So the company that I was working at, we had built an e-commerce, or they had built, I didn't build anything. They had built an e-commerce platform, and then there were a number of different sites that ran off of this e-commerce platform. And each of those different clients, partners, would request features. and they would be responsible partly for funding that feature, but the idea is that you build that feature into a platform and then can release it to other clients and partners. So what you want to do as part of the amortization is recognize, if I build this feature for client X, how many other clients might want that? And so how much over the budget that client X is paying for this can I go, and what other clients do I think will buy it, and how can I amortize that cost across those other clients? To make sure that I am making a profit on it. I can look at my clients and look at the overall P&L for each of my different clients and recognize which of them are profitable and which of them are not profitable. So which clients should I not renew my contract with, and which ones should I renew my contract with? Okay, so all of that is part of the amortization process, and some of that plays into the budgeting, because you might want to recognize that actually if it's going to cost us more than client X is willing to pay for it, and no one else would ever want this feature, then we probably shouldn't build the feature, right? So we want to know some of that actually upfront in this process here. I'm actually going to start with the recognition process because, one, I think it lays a good foundation, and two, it's the way we tackled it in the project. So some of the rules. This is some of the accounting rules, and it's a very simplified version of the accounting rules. I'm not going to go into accounting standards and all of that. That would be very, very boring. So let's just get all those up. Any increase in the value of an asset. So we've got this asset, it's software, it's been created. Any increase or change in the value of that asset must be auditable. I must be able to have KPMG come in and see a paper trail of saying, I have created this asset, it started out at this value, then I did this, and that made it this value. And this is a paper trail for what I did and how I can recognize. So I must be able to audit it. After I've released an asset and it started generating value, then continued ongoing maintenance of that asset is an expense. It can no longer be capitalized. There is a bit of leeway because the initial bugs, initial teething period, some of that expense can be capitalized. But once I've gotten over my teething period, then that expenses on that must be capitalized, must be expensed. It's the same as if we build a building, for instance. I put bricks and mortar together, I build a building, that building is an asset, I can sell that asset. If I need to repaint it, if I need to do the guttering, if I need to fix windows, those are all expenses, and I put those into a P&L, I don't put those on my balance sheet. Okay, so it's the difference between whether it goes into my P&L or whether it goes into my balance sheet. Typically, the amount of time that the developer or development team spends working on a project is directly related to the attributable increase in the value of that asset. Okay? Which is both a good thing and a bad thing, and we'll come on to that in a second. Okay, let's come on to that. So people do some work, they work for an amount of time, and that amount of time is loosely related to the attributable value of the asset. But it needs to be realistic. Like I said, it needs an audit trail. So I couldn't work for a day on a piece of software and then say, hey, this software is worth $1 million. Unless I'm paid $1 million a day. And anyone who wants to pay me $1 million a day, feel free to talk to me afterwards. But it's unlikely, right? So that the increase in value must have some correlation to how much I'm spending. It doesn't have to be all of it. It could be a little bit more, but it has to have some kind of correlation so the auditors can see where I got to the increase in value figure. Unfortunately, the outcome of this kind of thinking is that we have timesheets for developers because time equals money, and therefore I must add timesheets for developers. Leads to individuals who work the longest hours being considered the most valuable to an organization because, hey, they're adding the most value because they're spending the most time, therefore I've got the most capitalizable capitalizable value of their work. And then we optimize around resources. So this organization was attempting to achieve about 90% resource utilization across their developer pool. And they used to pull people off and on projects in order to maximize their utilization. And it was literally daily people were being flicked between projects simply to maximize utilization. And what they ultimately ended up doing is not delivering anything because people were just flicking around, right? So it was crazy. And what we tried to get across was the reality is that actually teams deliver value. It's not individuals. It's teams that deliver value. So what I was trying to do during this negotiation was trying to recognize how can we create a reporting structure that focuses on the value that teams are delivering rather than the value that individuals are delivering. Because you can see why accountants might think certain things. So like when we got to this point in the discussion with the accountants, they said to me, well, what we really want to know is if a senior developer is adding more or less value than 2 junior developers, because junior developers cost about half the price. And if I could fire some of my senior developers and just hire a couple more junior developers, that would be a whole lot more cost effective, right? Now, we all know that that's not true, but all the accountants were in a separate geographic location. They'd never been involved in the technology delivery. They'd never been involved in delivery teams. All they got were these numbers that said, we pay senior developers this, we pay junior developers this, these people contribute this much to the balance sheet, these people contribute this much to the balance sheet, balance it all out. Hey, we'd be better off getting rid of some of these people and hiring more of these people, right? They contribute more. We know that's not true, but I wanted a way that we reported that reflected that that was not true and that was not accurate, so you could understand in their decision making that that was a suboptimal decision, okay? So teams add value. Teams working together are more valuable than individuals working on their own. And that measuring individuals, not teams, actually reduces the effectiveness of the team because it incentivizes individuals to work as individuals to optimize their value to the organization rather than optimizing around how the team delivers value to the organization. So it's important, I think, to recognize that we want to drive value as a team, not drive value as individuals. So I went to the finance team and I brought to them a set of examples. I said to them, you're all reporting by timesheets. I've got a list of examples why these timesheets were not a good way of reporting. They're not accurate. People were making up numbers on the timesheets just to fill them in. It ended up in project stuffing. There's one project, the project that could not fail, right? So everyone knew that it was a project that could not fail. 87% of all people in the technology department had logged time against this project. 400 people had logged time against this project. Because they weren't actually working on it, but they knew they wouldn't get called out for putting time against this project. It didn't matter how far it went over budget. It couldn't fail. Therefore, it didn't matter if I logged time against this project. But what I really wanted to work on was this project over here, which no one would let me work on, right? But I knew it should be done, and I knew it had to be done, or I really felt passionate about it. So I would not log my time against a project that I was actually working on, but log my time against a project that could not fail. And therefore, I could get done what I wanted, and no one would come back to me, right? So one project way over budget, one project that disappears off the radar. And so they were making decisions by inaccurate information. And I went through this with the accountants, and they said, well, that's fine, because some of those decisions aren't ours to make. And two, what we really want, and all we care about from timesheets, is that someone has certified that this time was worked against this project. Therefore, when an auditor comes in, I've got a certified piece of paper to say, this person has said that they worked against this project, and that's why I increased the amount of the asset by this much. That's all they need is that piece of paper that says that, right? And I said to them, but you know it's wrong. And they said, I know it's wrong, but it's certified. Right? And you know, we get all these sorts of bad behaviors. Developers hate doing timesheets. Everyone hates doing timesheets. So we defer inputting timesheets to the last possible moment, and then you have to remember a whole week or 2 weeks of your time, and you're thinking, what was I working on 2 weeks ago Monday? I have no idea, right? Meetings, cross-project assistance, coaching, anything that's not project work simply gets dropped from your timesheets because you're just trying to fill them in as quick as possible. You make them up to the right number of hours because you know you've got to get 8, 9, 10 hours in the day, so therefore you just make it up to that number of hours. And it's demotivating because everyone hates doing timesheets. And in fact, in this organization, technology was the only department that had to do timesheets. So it was massively demotivating because no one else was doing the timesheets. What we learned? We learned that timesheets are a really bad way of capturing information. Self-reporting is not good in this space. It increases the focus on the individual, and we should stop using it. So how can we stop using time-based? We started to use a different approach. We already had all the information that we needed, right? This was our delivery, our software delivery software. Our delivery tracking software, there we go, that's a better word. Our delivery tracking software had all the information we needed in order to do financial reporting. So we could stop making people do timesheets, and we could just extract stuff out of our delivery tracking software. Measure the output of a team. By that point, we'd already transitioned to stable teams, so we'd stopped this shifting people around for resource optimization. We already had stable teams. We know how much those teams cost. Now we just need to extract something out of our delivery tracking software that gives us the right information that finance can use. We ended up with something like this. I did not want to put velocity into the hands of finance. And the reason I didn't want to put velocity into the hands of finance was because of behaviors like saying, well, this team's going at this velocity, this team's going at this velocity. Why don't we make them all like this team over here? They're going at 100. This team's just doing 28. Stuff like that was really bad. So I wanted to get velocity out of that. So what I did was I said, okay, well, each team is working on any number of features, and I take their velocity and split it out and say we did 10 points overall, 2 points was feature A, 8 points was feature B, therefore it's 80% on feature B, 20% on feature A, right? And that's all that finance needs to know, because from that, they can say, okay, team A costs me £5,000 a week. They spent 80% of their time on feature B, therefore that equates to £4,000 on feature B, right? And that gets them their number. And it's auditable because we've got our delivery tracking software that has that audit trail that tells us that, hey, this is how much time we've done in that time. We extract an Excel spreadsheet from that, which we then send to finance, which has all these numbers on it, and that's what finance gets, and they can log the audit from the balance sheet through, or the P&L, through the spreadsheet, through to the delivery tracking, with an audit trail on the delivery tracking that anything changes, we got a notification of change on the delivery tracking.
So what that delivery tracking software, what's it actually capturing to work out how much time you're spending on it?
So you can use Jira, you can use
Jira, for example.
Any one of those. So all you're looking at is saying, what stories did I finish in that period? How many of those, or how many of the points, how many of the stories, depending on whether you count throughput or velocity, how many of those relate to feature A, how many relate to feature B, and it's just then saying, add up all the stories for feature A, add up all the stories for feature B, add up my total, take it as percentages.
Oh, right. So you're
it's simple.
A proportion of the
just
total.
a proportion. It's just a proportion of the total delivered.
And that will satisfy UK tax?
That should satisfy UK tax.
Wow, okay.
Sorry, is that the total hours or the total points that you're
Total points. We wanted to get away from hours, right? So that was a deliberate effort to get away from hours worked, and do it for points. That was one of the tighter negotiations, because the finance department was, no, we have to have hours. I was like, okay, well, if we say that all the teams are working a standard number of hours in the day, and we know how much each of the teams work and who's in the team, so have to report who's worked on that project during that week or during that period. Then we know that this is what was the team structure for that week. This was what they delivered. We even it out and say that was the hours that they worked, right? Yeah.
I think what you're saying about it's about the cost of that team for that period.
Yes, the cost of that team. That's the key thing.
Somehow,
Yeah.
and then divide it across the features, right?
Yeah. And the cost of the team has to take into account things like holiday and things like sickness and that, because sickness is then not attributable to that project. You can't have all your team off sick and say I still increased the value of the asset by X amount. But finance got that information from HR. We gave them the project information, and then they reconciled those two across each other. Then there's the CapEx, OpEx debates. How do we recognize which part of this is CapEx? How do we recognize what part of it is OpEx? Capital expenditure, all the projects, at the start of the project, there's a negotiation between someone from finance and someone from the project team to understand what it is that they were doing and decide whether it was an OpEx or CapEx piece of work. There's a flag in the software that was either marked OpEx or CapEx, and that was then used as the indicator. And so on the reports, we'd indicate whether we actually had two sections. We had an OpEx section and a CapEx section, the projects and their percentages. So straightforward as that. Bugs in production were assigned either CapEx or OpEx depending on how long that feature had been in production. Now, and this is a big gray area, right? Because you get a bug into production and then someone has to assess it and say it belongs to feature A or feature B. But that's really hard because it could be that it's because of the interaction of those features. So is it directly attributable to feature A or directly attributable to feature B? And then, well, how long is long enough for it to be CapEx versus OpEx? What is the magic number? And it's a bit of a gray area that you can play with a little bit to understand what the right numbers are to meet the balance sheet needs. But a reasonable period of time, depending on how big the feature was, how much time since it was released, how many bugs you've had, how much usage it's had in the real world. All of those play a factor, and that became a gray area of negotiation. And what we ended up doing was making it very explicit on the bug. So there's a reporting section. We have chosen CapEx. It's CapEx because we believe it belongs to this feature, which was released here, and the bug was reported here. And so we'd make those decisions very explicit on the bug report, and we could then renegotiate that with finance if needed at a later point, as long as we were explicit about that.
Were you saying then that, so like basically the teams were aware of this, they were using this language of OpEx?
Yes.
You got that meant, and then
Yes. That was one of the things that we needed to get the teams to understand why it was important to recognize whether it was OpEx or CapEx.
So assessing the bugs, it's basically just the impact that will come into picture, right?
Yeah.
That's what we're looking at.
So what we had on a lot of the teams, we had two things. There's one triage team that so their time was, they took a look at all the bugs that they'd been working on in the triage team, and their time was split basically OpEx, CapEx based on what percentage of those bugs went to various different buckets. And then each of the different teams, they had an allocated amount of time, or a variable amount of time. It wasn't allocated, it was a variable amount of time that they'd spend on bug fixing. And then that time was divvied up, OpEx, CapEx, depending on what percentage ended up in which bucket here. Yeah?
Did you distinguish development from R&D?
This was entirely development. None of this was R&D. They had a separate R&D team. So, yeah.
Did the balance between CapEx and OpEx influence behaviour?
We didn't report we didn't have any incentives within technology for it to drive behavior. So there were incentives within finance to meet certain OpEx, CapEx targets, but we didn't show that information within. We just said this is important for reporting purposes. So the technology teams were not aware of what those OpEx, CapEx targets were. So we didn't want to distort technology behavior based on finance targets. So for budgeting, what did we do? This was our first pass. If only one team is working on the feature. And so the problem with budgeting is always the exact number. Finance gets a bit fixated on a single number if you give them a single number. We didn't want to give them a single number. So team sizes the projects in the normal way. They break it down however they work, either into stories or by point sizes or by comparable to a similar project. And then we got the average throughput or velocity of the team over the past 5 periods. 5 is an arbitrary number that we used. You could use larger or smaller ranges, plus or minus 2 standard deviations, and gave us an estimated cost low and estimated cost high. And we always expressed to finance when we were budgeting, we always expressed a cost range. So we'd say to them, this is the range within which we expect to deliver this piece of software. It's not a single number, it's a range, and that's the algorithm we're using. We were very explicit, this is how we calculated it. These are all the numbers that went in, this is the number that came out. These are high-low range. Always as a range. Yeah, that's that one. Okay, so that was our first pass. So we'll come back to the second pass in a minute. If two teams are working on the project, because often you have a back end, it's split across two separate teams. One feature comes in, it needs to two teams working on it. We do the same process. The work is broken down by two teams. They understand you're going to do this part, you're responsible for that part. You size that part, we'll size this part. Add the high number, add the low number, put them together, you've got a range. Right. Simple as that. Keep it nice and simple, keep it obvious, keep it simple. Outcome of this compared to what they were doing previously, where the teams were asked to give a single number and stick to the number, was we had much better conversations about the value of a project because we were expressing it as a range. The variability was understood much better, and there's a lot less insistence on teams fitting to that final budget number and not going over the budget number. So it was much better conversations with stakeholders, better conversations with finance about that. Reconciling it, we use the same formula during the reconciliation process to say, okay, we've got this much remaining in our backlog for this feature. Remaining size, look at my average throughput high, average throughput low, multiply by the team, gives me my remaining cost high, low. That's also expressed as a range. So I've worked on it for this long, I've added this much value to the balance sheet, and my range for budget on completion is between this and this.
What do you suggest for things like tech debt or products that came to play?
Can I come back to that at the end if I've got time?
Yeah.
So that I can get through this, that'd be great. But it's a really good question. I just worried about time. So same calculation, which makes it nice and simple because you're using the same formula all over the place. I started to do some modeling with the data that was coming through on this, and I've done some modeling on previous projects. And I started to notice this. So frequency of stories, cycle time of stories. And if anyone recognizes the curve, it's more or less log normal curve with a bit of a deeper tail than a standard log normal would have. So it's a bit of an extended tail over log normal. But pretty consistently, I was getting that kind of shape of data out of the stories. So I started looking at that and thinking, well, we're using a very heuristic method to try and calculate stories. And actually, what that tells me is that we're better off using a statistical method because we've actually got a statistical curve there. So in our second pass, we built a stochastic model that looks at the delivery rate of the team, run a Monte Carlo simulation against the new features, and then we used percentiles. So 65th percentile, if I run a Monte Carlo simulation, it tells me that I'm 65% likely to finish this in a month, but 85% likely to finish it in 3 months. Okay, well, that gives me my cost range, high, low, multiplied out, right? And actually, it's a lot less work for the teams because these Monte Carlo simulations actually take away a lot of variability within forecasting, within trying to estimate stories. So that's worth looking at. Building stochastic models is a bit tricky sometimes, but if you start simple and build it up, it can be a very powerful tool. And we did the same thing with the reconciliation. If we want to reconcile how much more in our budget needs to go forward, well, we do the same sort of calculations, 65%, 85%. I use 65%, 85%. You can use other number percentiles depending on how risk averse you are. You can take that out to 90%, or you can take it down to 80, 75% if you're really risk pro. But yeah. Then the amortization. How am I doing for time? Oh, close. Okay, amortization. Attribution across multiple clients. In order to attribute across multiple clients, the first thing I need to know is I need to know the lifetime value of the feature. In order to understand the lifetime value of the feature, I need to know its uptake, so how many clients are going to buy into this feature, how many people are going to use it, what are they willing to pay for it, and how long are they going to use it for. And I want to try and model something that tells me what's the total lifetime value of this feature. Because once I've got the lifetime value of the feature, I can figure out So then I've got the lifetime expected revenue of the feature, I've got the cost of the feature, and then I can start reconciling cost to value. Is this actually something that's worth building, or is it not something that's worth building? Because if the overall value is not worth more than the cost, then there's no point in doing it. And then it allowed me to then reconcile how much I was going to attribute to each of the clients based on their uptake and their revenue. The way we did that is to do probability modeling of different scenarios. So I'd say that we have one client who's 100% willing to take it because they're the one who's funding it. We think that in the first year, there's a 30% chance that we'll get between 1 and 3 other clients buying it, etc., etc. And we build out a probability model and then run Monte Carlo simulations against that. Again, run Monte Carlo simulations through that stack, see how it comes out, what the probability value is. I'm 85% sure that I'm going to get this kind of revenue, 65% sure that I might get this kind of revenue. That's kind of my revenue estimate for the feature, and then I can make a decision as to whether I want to go forward. And depending on my tolerance for risk, as to what I set those percentiles at, again, if my tolerance for risk is really high, I can set them lower. If my tolerance for risk is really low, I can set them higher. Entirely up to you. I'm not going to spend a lot of time on this. This is what we've been talking through. This is what tech did. Really just simple highlight of, it is really just boils down to 5 things that tech needs to report into finance. And they're all really simple, automated as much as possible. The only one that we really need to keep track on is which team members were working on which days in which team. And that's really all we need to keep track of manually. The rest is all done through our software tracking, our delivery tracking system. Finance, at the end of the period, finance can calculate the cost of a feature, the projected cost of features in progress, projected cost of development feature, and the delta between the original budget and the estimate. And they can continuously track this over the life of the project. When they first came to us, they were always insisting that we report the original budget rather than our future estimated budget. And I said to them, well, that's ridiculous, because then you're making a decision based on information that's old, and it'd be much better if you had the latest information. You could make a decision based on how much we actually think we're going to spend, not how much we thought we were going to spend 2 months ago. So we got to the point where we're actually doing a really good, and we could do it. The cool thing is you can pull that data for any range. So if you've got your delivery tracking software set up nicely, you can say, I want to report for a week, I want to report for 2 weeks, I want to report for 4 weeks, I want to report for a quarter, for a year, for half a year. And it doesn't matter, because the numbers always come out in a way that's easily reportable. So you can report over any period that finance wants to use it for, which makes it really quite useful. At the end of each period, auditors can review the project tracking software, they can review staff assignments, they can review the project breakdown, and they can trace that back up into how that goes into the P&L and how that goes into the balance sheet. Automation, reporting at any time, fully auditable, satisfied the requirements for finance. And 3 minutes over, that's it. Questions, comments? Very quickly. Tech debt. Okay, I should come back to tech debt. The way we handled tech debt was as a requirement from technology. So it comes in as, this is a feature, this is a piece of work that we need to do within technology in order to maintain the quality and the evolvability, as you heard this morning. It was nice, I like that, evolvability of the code. So it comes in as a requirement from technology, and then it's a conversation between finance and the tech leads as to whether they think that is operational or capital expenditure, depending on whether it's fundamentally increasing the value of the asset or simply fixing something that we failed to do previously.
But isn't it natural from the finance team to resist that, to invest in something which is not going to give us revenue?
It wasn't their decision to make. So it was explicitly not their decision to make as to whether we invested in that. Yeah.
In your formula, you had average throughput. Is that velocity?
Yeah, average throughput, average velocity. So it depends on whether you're counting cards and that's just the throughput, or whether you're counting points, in which case you go through with velocity.
So you haven't found that finance has abused that velocity? I know you mentioned it right at the start.
We never expose the actual velocity to finance, so we only give them the final number, the calculated numbers. We never give them velocity for them to abuse it.
Yeah.
Yeah.
And what tools do you use to help you with the Monte Carlo simulation?
Troy McGinnis's tool. If you look up Troy McGinnis, he wrote a tool which does fantastic Monte Carlo simulations. I used to have a big spreadsheet that I made for myself that does Monte Carlo simulations. Became a nightmare to maintain. Troy McGinnis has some great tools.
What about time that couldn't necessarily be allocated to a feature? So, for example, we're here today, that's the day you've got to account for. How
Yep.
can that fit into this process?
One of two ways. So I think that the nice thing about this is it recognizes that teams aren't always working on code. And actually, it is productive and useful for teams not to be working on code sometimes, because there's learning, there's coaching, there's facilitation, there's cross-team communication. All of these things are essential parts of building software that are not intrinsically linked to writing code, but all of them add value overall. So there are two ways. For a full day like today, you might have a separate P&L entry, but for ad hoc things that happen as part of a development process, that just simply becomes part of that calculation because it's incorporated into your throughputs and velocity numbers, because they're a natural part of throughput and velocity. Yeah.
So I can see that in the case where the bean counters come to us and say, when we count these beans, this is a really great answer. I like to see. But what I really want to say is these are not the beans we're looking for.
Yes.
They are, we're, in this story, we're playing the game of agreeing that the value of the software we build is in the software somewhere, and you could weigh it on scales and say it has this much value in it.
Yeah.
But I want to say that really the value in the software comes from the discounted cash flows that come from the users using the features that we build, and that's orthogonal to how much it costs.
Yeah.
How much I have to capitalize
Absolutely.
to get to have the feature.
And I 100% agree with you. Unfortunately, there are a set of rules that accountants work by, which is how they report into the city, which is how they report into shareholders, which are how they report into the board, and I can't change those rules. So
You can't change the rules, but you could perhaps make an argument that they're using the wrong set of rules.
But it doesn't matter because they are accounting rules. So
I'm not saying you set out to turn the discipline accounting upside down. What I'm suggesting is, I might give you an idea. I'm suggesting essentially that this isn't the kind of thing you're thinking of.
Yeah.
It isn't like building a building. It's a different kind of activity, and you need to use of your vast gamut of accounting rules that there are for all kinds of things. You're not picking the right subset to deal with this kind of activity.
yeah, and
I don't know that they have an option.
I don't think they have an option. So, for instance, this company they'd been on the stock market for 5 years. They already had forecasts of their capital growth, forecasts of that they'd reported into the city, and their stock price is very sensitive to those changes to that. You can't suddenly make a break change in your reporting to the city. Companies are too risk averse to do that generally. You can, but what I'm saying is that the companies are too risk averse to do that. The board won't agree it.
There do exist companies, there do exist functional, profitable companies trading on the stock exchange who don't make a capitalizable thing.
Yes, agreed.
And they have to account somehow and publish if they're traded, they have to do their reports to the market and so on and so on and so on.
But what I'm saying is that a company that's already been listed, that already has forecasts, that already has a board, is not going to make that change. I had the conversation with them, and that was absolutely not going to happen. There's absolutely no way that was going to happen.
You have a conversation with your board that they would.
Yeah.
That's not the same as no company would.
No, agreed. I think it's very sensitive. Anyone else? Yeah?
A client that I work with has calculated the monetary value of a story point, and uses it to figure out how much features are costing him. How do you feel about this?
Awful. So, so one of the questions that I was, well, one of the things that came up when we were doing this, going through this process was we were doing various models and testing them on finance to see how they'd work. And when we reported velocity into when we had a model that reported velocity into finance, we played a scenario of team A estimating a feature at 50 points and their velocity is 10 points an iteration. Team C has 20 points per iteration and for their velocity, and the finance team were like, well, we should give this feature to Team C to do because they're obviously going to do it in a lot less time, right?
You can standardise story points across agile teams. It is common practice in large organisations. They say, this is on the beach, we're going to take all one team to the other and say, this is 20 points, and this is 0.3 points. So it is possible. Some organisations say we don't want
I think it depends on what you're trying to achieve, but ultimately what we ended up doing was not reporting velocity to finance, that those comparisons couldn't be drawn.
This is just one team though, and this guy is deeply ingrained in the team, so he knows exactly what the team can get through, and he thinks it's an exacting science.
I'd say it's not, and then one of the reasons that I think it's a very poor science is because if you actually take a look at doing this, if you actually build a stochastic model, so build a statistical model that models your team, what you find is that we typically try and estimate using heuristic models, where we think, I can sit down and I can lay out, these are the things that are going to go through this development process, I can size each of those, I can go through, add them all up, and this gives me my total size for this project. And it plays against all our biases as humans. We have familiarity biases and we have all sorts of cognitive biases that prevent us from being able to build a good heuristic model for something that's as complex as building software. And so when you start using stochastic models that take into account events that happen infrequently but have an adversely high impact on your capability to deliver, you suddenly start realizing that actually my heuristic approach of trying to understand number of points and adding them up and thinking that that's going to come to total is actually wrong. And actually, I'm much better off having a stochastic model but you've got to build that model together with the team and understand how the team is working and refine it constantly and constantly be checking it to make sure that it reflects the team. But that is a far better way of looking at the projected cost. And once you've got a model that's reasonably accurate and reasonably good at forecasting, then you can say, oh, 85% confident that I'm going to get, with these underlying assumptions, 85% confident that I'm going to get this number off at the end. Yeah, fine.
So what happened to the buried projects? Did they just don't disappear then? And the stuffed projects?
Yes, because we became a lot more transparent about the reporting, and it became impossible to then.
Yeah, so those buried projects that people thought were really critical just got dropped.
Well, then it became more of a negotiation around saying, we think this is critical because.
Yeah.
Rather than, I think it's critical, no one's going to listen to me, so I'm just going to bury it. Right? It became, I have to be explicit, I have to be communicative, I have to bring a reason for why I think this is a good project, which is a much healthier discussion.
We've got 2 minutes left.
2 minutes left.
So to some extent you've done a really good job of mitigating some of the bad issues or bad influences that come from finance. I was wondering if you can think of or look about any good issues or good influences which come from the finance department onto technology.
So I think some of the things is consideration around real consideration around financial value of the things that we do and the implications of that. So like when we started to look at the attribution models and understanding that this feature, it needs to be attributed across multiple different clients. So when the teams are building the feature, they're not looking at it and thinking, I'm building this feature and it's going to go to client X and I don't really care about the wider space, but they have an understanding of actually, I know client Y and I think that they might like this feature, but if I build it like this, it's not going to be right for them. So it's a consideration around the overall extent of what that feature might do, or if it's a feature that only client X is going to use, then let's just narrow it down. Let's not think about the other clients. Let's just focus on client X and ship it for client X. So it created a focus on, because we had that earlier attribution model, we could then bring a focus on what is it that we actually want to do with this feature, rather than saying everything needs to be a general feature or everything needs to be a specific feature, which was kind of the way it was before. One last question.
When you're working with clients rather than selling the tax man, have you experienced how you go from one weekly time out saying this is exactly how many hours that we're billing you for to percentage-wise the team work on 80% for your project? Like, how does that conversation go in terms of that?
So these are all internal teams.
So you've never taken this externally?
So these are all internal IT teams reporting to their internal finance departments. I think it's a very different relationship when you've got a contracting or consulting team interacting, because there you need slightly different bills of invoice in order to manage that. And that's a bit of a different relationship.
So you still want them to time something?
For the purposes of invoicing at that point, yes, I need a time-tracked invoice, because I can't pay off of the back of a percentage invoice. So I'd need a time-tracked invoice.
We've managed to do something a bit like that.
Yeah?
Relationship with our customers.
Cool.
And we sort of charge for a fixed sort of sprint price, and so we charge them that, and then we should report on the percentage of what they got in that sprint.
Nice.
Yeah, we work the similar thing to CPR, cost per installation, but something,
Yeah. No, in this one we just had a separate. In terms of the stuff that went to finance for recognition of assets, we had this, and in terms of invoicing for contractors, we had a timesheet, a separate timesheet that the contractor submitted. But that was handled separately. Cool. That's it. Thank you all.